Hey everyone, welcome back to the channel. Today we're diving into a topic that's close to all of us, building wealth. Let's be real, who doesn't want to achieve financial freedom and live life on their own terms? Now, I know what you might be thinking. Building wealth is only for the rich, right? Wrong. This video is your blueprint to understanding the various asset classes that can help you build wealth, even if you're starting with a middle-class income. Over the next few chapters, we'll be exploring 20 different assets, breaking down their potential for growth and income. We'll be real and transparent, discussing both the positives and negatives of each, so you can make informed decisions about where to put your hard-earned money. Remember, building wealth is a marathon, not a sprint. So, buckle up, grab your notebooks, and let's get started on this journey to financial freedom together. First up on our list is real estate, a classic wealth-building tool that's been around for centuries, and for good reason. Think about it. Everyone needs a place to live, right? That's why owning rental properties can be such a powerful way to generate passive income. Imagine this, you buy a property, rent it out, and suddenly you've got a steady stream of cash flowing in every month, even while you're sleeping. Plus, there's the potential for property appreciation. As the value of your property goes up over time, so does your net worth. But, and this is a big but, real estate isn't for the faint of heart. It requires significant upfront capital. We're talking down payments, closing costs, and potentially even renovation expenses. And let's not forget about the ever-present market risks. Remember the 2008 housing crisis? Real estate markets can be cyclical, and if you're not careful, you could end up underwater on your investment. Now, don't let the risks scare you off completely. With proper research, due diligence, and a solid understanding of the market, real estate can be a fantastic wealth-building vehicle. One strategy I always recommend is to start small. Consider investing in a duplex or a small multifamily property, live in one unit and rent out the others. That way, you're generating rental income while also building equity in your own home. Another crucial aspect is location, location, location. Investing in up-and-coming neighborhoods with strong rental demand can significantly increase your chances of success. Remember, real estate is a long-term game. It's about building a portfolio over time, riding out market fluctuations, and ultimately reaping the rewards of your hard work and smart investments. Next up, we're diving into the exciting world of stocks. Now, stocks can seem intimidating at first, but they're essentially just tiny pieces of ownership in publicly traded companies. Think Apple, Tesla, or even your favorite coffee shop chain. The beauty of stocks lies in their potential for high returns. We're talking about two main avenues for growth: dividends and capital gains. Dividends are like little bonus payments that companies distribute to their shareholders, while capital gains represent the increase in the stock's value over time. But hold your horses before you go all in on the latest hot stock tip. The stock market is known for its volatility. Prices can go up and down like a roller coaster, sometimes even within the same day. That's why it's crucial to do your research, understand the companies you're investing in, and diversify your portfolio to mitigate risk. Don't put all your eggs in one basket, or you might end up with a nasty surprise. Now, I know what you're thinking, all this talk about volatility sounds risky. And you're right, investing in individual stocks does come with its fair share of risk. But remember, the stock market rewards patience and long-term thinking. Instead of trying to time the market and make a quick buck, focus on investing in fundamentally strong companies with solid track records and a bright future. Think of it like owning a piece of a business. You wouldn't sell your share of a profitable business just because of a few bad days, right? The same principle applies to stocks. Ride out the dips, stay informed, and over the long term, you'll be amazed at the power of compounding returns. And hey, if you're still feeling unsure about navigating the stock market on your own, there are always resources available to help you. Financial advisors, robo-advisors, and even educational platforms like Investopedia can provide valuable guidance and support. Alright, let's talk bonds. Bonds are like the reliable, responsible friend in the investment world. They offer predictability. When you buy a bond, you're lending money to a government or corporation. They promise to pay you back with regular interest payments. The interest rate depends on the bond's length and the borrower's creditworthiness. U.S. government bonds are super safe but pay lower interest rates. Bonds offer fixed returns, but there are risks if interest rates rise. There are different types of bonds out there. Government bonds are the safest. Corporate bonds offer higher returns but more risk. Municipal bonds can offer tax advantages. Bonds have different maturities. Choose bonds based on your goals and risk tolerance. Ever feel like investing in the stock market is like trying to understand a foreign language? You're not alone. It can be intimidating, right? That's where mutual funds come in. Think of a mutual fund like a basket of stocks or bonds. Instead of buying individual stocks, you buy into a mutual fund. This diversification reduces risk. Mutual funds are professionally managed, but they come with fees, so compare before you invest. Walking into the world of mutual funds can feel like stepping into a gigantic supermarket. There are thousands of mutual funds, each with its own strategy, risk, and fees. How do you choose the right one? First, figure out your investment goals. Are you saving for retirement? Buying a house? Once you know your goals, research funds that match. Look at performance fees and holdings. Don't just trust past performance. Ask for help if needed. A financial advisor can guide you. Investing is a marathon, not a sprint. Choose wisely to build wealth long-term. Mutual funds are like the reliable station wagons of investing. Now, let's talk about their cooler cousins, ETFs. ETFs offer instant diversification, like a pizza with all the toppings. But here's the key difference. ETFs are traded on stock exchanges. This means you can buy and sell them throughout the trading day. ETFs generally have lower fees and expense ratios. So, ETFs offer the diversification of mutual funds with the flexibility and lower costs of trading individual stocks. There's a whole universe of ETFs out there, each focusing on different sectors, industries, or investment strategies. You've got ETFs that track the S&P 500, ETFs that invest in emerging markets, ETFs that focus on renewable energy, you name it. It's like walking into a giant candy store. So, how do you choose the right ETF for you? It all comes back to your investment goals, risk tolerance, and time horizon. Are you bullish on tech? There's an ETF for that. The beauty of ETFs is that they allow you to tailor your portfolio to your specific interests. But remember, just like with any investment, ETFs come with risks. The value of your ETF can go up or down. So, do your research, understand the risks, and make sure your investments align with your financial plan. And if you're not sure where to start, don't be afraid to ask for help. Talk to a financial advisor, do your own research, and remember, the best investment you can make is in yourself. Cryptocurrencies like Bitcoin and Ethereum have exploded in popularity, and for good reason. I mean, who wouldn't want to potentially 10 times their money overnight? These digital currencies operate independently of any central bank, offering a level of decentralization that's super appealing, especially in today's economic climate. But, and this is a big but, you gotta remember that with high potential rewards come high risks. Crypto is known for its extreme volatility. Remember back in 2017 when Bitcoin skyrocketed to almost $20,000, then crashed down to a fraction of that? Yeah, that kind of volatility can make even the most seasoned investor a little queasy. And don't forget about the regulatory landscape. Governments around the world are still trying to figure out how to handle crypto, which adds another layer of uncertainty to the whole thing. If you're thinking about dipping your toes into the crypto waters, The first thing you need to do is educate yourself. Don't just blindly follow what some influencer on Twitter is telling you. Do your own research, understand the technology behind it, and for heaven's sake, only invest what you can afford to lose. Now, when it comes to actually buying crypto, you've got a ton of options. You can go with a popular exchange like Coinbase or Binance, or if you're feeling a little adventurous, you can even try your hand at decentralized exchanges. Just remember, security is key, so choose a reputable platform and keep your digital assets safe and sound. And here's a pro tip. Don't put all your eggs in one basket. Diversify your crypto holdings just like you would with any other investment. Spread your risk across different coins and projects that you believe in. And remember, this is a long-term game, not a get-rich-quick scheme. Remember that saying, "They're not making any more land"? Well, the same goes for gold and silver. These precious metals have been a store of value for centuries, and for a good reason. They've got this intrinsic value that transcends fiat currencies, which can be pretty comforting when the economy starts looking shaky. Now, I'm not saying you should go full-on doomsday prepper and bury all your savings in your backyard, but having a small allocation to precious metals in your portfolio can act as a hedge against inflation and economic uncertainty. Think of it as an insurance policy for your wealth. Now, before you run out and buy a vault full of gold bars, let's talk about the downsides. Unlike stocks or bonds, precious metals don't really generate any income. You're basically betting on their price appreciating over time. And then there's the storage issue. If you're buying physical gold or silver, you're going to need a safe place to keep it, which can come with its own costs and security concerns. Of course, you can always invest in gold ETFs or mining stocks, which can be a more liquid and convenient option. Ultimately, whether or not precious metals are right for you depends on your individual risk tolerance and investment goals. If you're looking for a way to diversify your portfolio and potentially hedge against inflation, then a small allocation to gold or silver might be worth considering. Alright, let's talk about something a little more fun, shall we? Collectibles. Now, this category is about as broad as it gets. We're talking everything from rare stamps and vintage comic books to classic cars and designer handbags. The cool thing about collectibles is that they can offer a unique combination of potential investment return and personal enjoyment. I mean, who wouldn't want to own a piece of history or a rare piece of art that they're passionate about? And the best part, the collectible market is vast and constantly evolving. There's something for everyone, no matter your interests or budget. Whether you're into sports memorabilia, vintage toys, or rare coins, there's a whole world of collectibles out there waiting to be discovered. Now, before you go emptying your bank account on a vintage Pokémon card, there are a few things you need to know about the collectible market. First and foremost, it can be highly illiquid. Unlike stocks or bonds, which you can buy and sell with a click of a button, finding a buyer for your prized possession can take time and effort. And just like with any investment, knowledge is power. The more you know about the specific niche you're interested in, the better equipped you'll be to spot valuable items and avoid getting ripped off. Do your research, attend auctions, and connect with other collectors to learn the ropes. And here's a golden rule. Only invest in collectibles that you genuinely love and appreciate. That way, even if your investment doesn't pan out the way you hoped, you'll still be left with something that brings you joy. Remember, it's about finding that sweet spot between passion and profit. Now let's talk about art. And no, I'm not talking about picking up a paint-by-numbers kit at the store. I'm talking about investing in legitimate pieces of art. Think paintings, sculptures, installations, the kind of stuff you see at museums and high-end galleries. Now, art can be a tricky asset class. It's not as straightforward as, say, buying a rental property, but if you know what you're doing, it can be incredibly rewarding. The art market, just like real estate, can be very lucrative. Some pieces appreciate in value significantly over time. You're essentially betting on an artist's legacy and the enduring appeal of their work. But here's the catch: you need to know what you're looking for. This isn't about picking something you think looks nice above your couch. It's about understanding art history, trends, and having a keen eye for quality and potential. The art world can be intimidating, especially for newcomers. It's full of jargon, high prices, and a certain level of exclusivity. But don't let that scare you off. There are resources available to help you learn the ropes. Start by researching online, attending gallery openings, and connecting with art professionals. One thing that makes art tricky is its illiquidity. Unlike stocks that you can sell with a few clicks, offloading a piece of art takes time and effort. You need to find the right buyer, someone who appreciates the art and is willing to pay your asking price. And then there are the costs. Transaction fees for buying and selling art can be significant, so factor that into your calculations. But hey, if you play your cards right and land a masterpiece, the payoff could be huge. Alright, let's dive into something a little different. Peer-to-peer lending, or P2P lending for short. This is a relatively new way to invest, and it's all about connecting borrowers directly with lenders, cutting out the traditional banks. Think of platforms like Lending Club or Prosper. You're essentially acting as the bank, loaning your money to individuals or small businesses. Now, why would you want to do this? Well, the potential returns can be much higher than what you'd get from a traditional savings account or even bonds. You're taking on more risk, of course, but with higher risk comes the potential for higher reward. Plus, there's a certain satisfaction in knowing you're helping someone achieve their financial goals, maybe consolidate debt or start a business. But let's be real, P2P lending isn't without its risks. The biggest one? Borrower default. There's always a chance that the person or business you lend to won't be able to repay the loan. That's why it's crucial to diversify your investments. Don't put all your eggs in one basket, or in this case, one borrower. Spread your money across multiple loans to mitigate the impact of a potential default. Another thing to keep in mind is liquidity. Unlike stocks that can be sold quickly, it can be difficult to get your money out of a P2P loan before its maturity date. So, make sure you're investing money you won't need in the short term. If you're comfortable with the risks, P2P lending can be a solid addition to your investment portfolio. Now let's talk about REITs, or real estate investment trusts. These are companies that own, operate, or finance income-generating real estate. Think apartment buildings, shopping malls, office spaces, the kind of properties that generate a steady stream of rental income. REITs offer a way to invest in real estate without actually having to buy, manage, or deal with tenants. You're essentially buying shares of a company that owns and operates these properties. And the best part? REITs are required by law to distribute at least 90% of their taxable income to shareholders in the form of dividends. That means you get a nice, steady stream of passive income. One of the great things about REITs is that they offer built-in diversification. Instead of putting all your money into a single property, you're investing in a portfolio of properties across different sectors and geographies. This helps to spread your risk and potentially increase your returns. Now, like any investment, REITs come with their own set of risks. The real estate market can be cyclical, meaning prices go up and down. When the economy is doing well, REITs tend to do well. But during economic downturns, REIT prices can fall. It's also important to remember that REITs are still subject to market fluctuations. So while they offer diversification within the real estate sector, they don't provide complete insulation from market volatility. Not ready for the stock market or real estate? That's okay. High-yield savings accounts are a simple way to build wealth. Forget the low rates from traditional banks. Online banks offer better rates, They save on overhead costs. More money for you. FDIC insured, your money is safe. It's a financial safety net. Yes, I'm recommending a savings account for your emergency fund or short-term goals. Let your money work for you. So, how do you find the best high-yield savings account? Well, it's all about doing your research. Compare interest rates from different online banks, look at their fees or lack thereof, and check out their customer reviews. You want a bank that's reputable, reliable, and offers a rate that aligns with your financial goals. Remember, interest rates can fluctuate, so it's essential to stay informed and be willing to switch banks if a better opportunity arises. Don't be afraid to shop around and find the best deal for your hard-earned money. Trust me, your future self will thank you for it. A high-yield savings account might not be the most exciting investment strategy, but it's a crucial foundation for any solid financial plan. It's like building a house. You need a strong foundation before you can start adding the fancy stuff. Looking for a hands-off way to grow your money with a guaranteed return? Certificates of deposit or CDs might be for you. You lend money to a bank for a fixed period and they guarantee a specific interest rate. The longer the term, the higher the interest rate. But beware of early withdrawal penalties. CDs are best for money you won't need soon. CDs can be a valuable tool for diversifying your investment portfolio, especially if you're looking for stability and predictable returns. They can act as a counterbalance to more volatile investments like stocks or even real estate. However, it's important to remember that while CDs offer a guaranteed return, they might not always keep pace with inflation. If inflation is higher than the interest rate you're earning, your money could actually be losing purchasing power over time. So, while CDs can be a safe and reliable investment, it's crucial to consider your overall financial goals, risk tolerance, and the current economic environment before diving in. Diversifying your portfolio and having a mix of short-term and long-term investments is key to weathering any financial storm. Annuities can seem a bit complicated at first, but they're really just a contract between you and an insurance company. You give them a lump sum of money, and they, in turn, provide you with a stream of income, typically during retirement. Think of it like creating your own personal pension plan. Now, annuities come in different flavors. You've got fixed annuities, which offer a guaranteed interest rate, providing predictable income. Then there are variable annuities where your returns are linked to the performance of underlying investments like mutual funds. Variable annuities offer the potential for higher returns but also come with more risk. Annuities can be a good option for those looking to secure a guaranteed income stream during retirement. They can provide peace of mind knowing that you'll have a steady flow of cash coming in, regardless of how the market performs. Of course, like any financial product, annuities have their pros and cons. One of the biggest advantages is the potential for tax-deferred growth. This means your money can grow without being taxed until you start receiving payments, potentially maximizing your retirement income. However, annuities often come with hefty fees which can eat into your returns. These fees can include mortality and expense charges, administrative fees, and surrender charges if you need to withdraw your money early. It's crucial to understand all the fees associated with an annuity before you invest. Annuities can be complex, so it's essential to do your homework, and if needed, consult with a financial advisor who understands your specific financial situation and goals. They can help you determine if an annuity is the right fit for your retirement plan and guide you through the different options available. Now let's talk about building something of your own, business ownership. There's a reason why so many people dream of being their own boss. The potential upside is huge. You can create something you're passionate about, and you're in control of your own destiny. There are tons of examples of people building successful businesses from the ground up. Think about the coffee shop on your block, or that local clothing boutique. They all started with an idea and a whole lot of hustle. But, and this is a big but, business ownership is not for the faint of heart. It takes a tremendous amount of work, dedication, and yes, risk. You're not just putting in your 40 hours a week and calling it a day. Be prepared for long nights, tough decisions, and probably a few setbacks along the way. You're also on the hook for everything. If the business isn't doing well, you're the one who has to figure it out and make the tough calls. Before you dive headfirst into starting a business, you need to do your homework. What problem are you solving? Who's your target audience? What's the competitive landscape like? A solid business plan is essential. Trust me, I've seen too many people jump into entrepreneurship without a clear plan, and it usually doesn't end well. You need to know your numbers inside and out. What are your startup costs? What's your burn rate? When can you realistically expect to turn a profit? These are crucial questions that need answers before you risk your hard-earned money. If the thought of starting a business from the ground up seems daunting, a franchise might be a better fit for you. With a franchise, you're essentially buying into a proven system. You're getting a recognizable brand, established processes, and often training and support from the franchisor. Think about it. When you see a McDonald's or a Subway, you know exactly what you're going to get. That brand recognition and consistency is a huge advantage, especially when you're starting out. You don't have to reinvent the wheel. You're getting a playbook that's already been tested and refined. Plus, you often get access to the franchisor's marketing muscle, supply chain, and even help with things like site selection and lease negotiations. Of course, all of this support and brand recognition comes at a price, and it's not cheap. Franchise fees can be substantial, often ranging from tens of thousands to even hundreds of thousands of dollars depending on the brand. And that's just the upfront cost. You'll also have ongoing royalties and advertising fees you'll need to pay to the franchisor, usually a percentage of your sales. So before you sign on the dotted line, make sure you understand the full financial picture. Read the franchise disclosure document carefully, talk to existing franchisees, and do your due diligence. Remember, even with a proven system, success isn't guaranteed. You'll still need to work hard, manage your business effectively, and provide excellent customer service to thrive. You hear it all the time, ideas are valuable. But with intellectual property, you can turn those ideas into tangible assets that generate income. This can include things like inventions, literary and artistic works, designs, symbols, and even images and names used in commerce. Think about the iconic Apple logo, the catchy jingle from your favorite commercial, or even the patented technology in your smartphone. These are all forms of intellectual property, and they're incredibly valuable to the companies that own them. Now you might be thinking, Graham, I'm not inventing the next iPhone anytime soon, and you know what? That's okay. Intellectual property can take many forms. Let's say you're a writer, a musician, or a software developer. You're creating intellectual property all the time. The key is to protect it. That's where things like copyrights, trademarks, and patents come in. They give you legal ownership of your creations and prevent others from using them without your permission. Once you've protected your intellectual property, you can start thinking about ways to monetize it. You could license your music to be used in films or TV shows, sell your designs on merchandise, or even create online courses or ebooks based on your expertise. The beauty of intellectual property is that it can generate passive income. You put in the work upfront to create and protect it, and then it can continue to generate revenue for years to come. It's like planting a money tree that keeps on growing. What comes to mind when you hear the word commodities? Maybe you think of oil barrels, gold bars, or even those giant sacks of coffee beans. Commodities are raw materials or agricultural products traded in bulk. They are the building blocks of the global economy. From the gas in your car to the cornflakes you eat, commodities are everywhere. They can also be a hedge against inflation. Let's talk about investing in commodities. You can buy and sell physical commodities. Imagine a vault of gold or a silo of wheat. But storing them is costly and complex. Plus, logistics can be a hassle. Commodity futures contracts simplify this. They let you trade without owning the commodity. But remember, markets are volatile. Do your research and understand the risks. Consider seeking advice before trading. Alright, let's dive into the world of foreign currencies, also known as Forex. Now this is where things get really interesting. Trading currencies means betting on the rise and fall of economies. You could profit from emerging markets or global superpowers, but Forex trading isn't for the faint of heart. It's incredibly volatile, and even experts can get burned. Remember, forces can shift your money's value overnight. So how do you get started? Understand macroeconomic factors and trading strategies. Diversify to mitigate losses and increase success. Forex can be incredibly lucrative, trading trillions daily. But high returns come with high risks. Currencies can fluctuate wildly. Leverage amplifies gains and losses. Understand and use it responsibly. Geopolitical events impact currencies. Be prepared for the unexpected. With knowledge and caution, Forex can be profitable. It's not a get-rich-quick scheme. It takes time and dedication. Let's talk about venture capital, or VC for short. Investing in startups can disrupt industries and change the world. Think Airbnb, Uber, Google. All started with VC funding. It's a high-risk, high-reward game. Most startups fail, but successful ones can be life-changing. Venture capitalists invest for equity, seeking disruptive ideas and strong leadership. It's not for everyone. It requires high-risk tolerance and deep understanding. Now, getting into venture capital isn't easy. It's a highly competitive and exclusive world. You need a strong network and deep industry understanding. Investing in venture capital funds is another option. These funds pool money to invest in startups. Diversify your risk, but watch out for high fees. Always do your due diligence before investing. Research the team, market, and competition. The more you know, the better your decisions. And there you have it, guys. We've covered 20 different assets that can help you build wealth and achieve financial freedom. From real estate and stocks to cryptocurrencies and venture capital, we've explored a wide range of investment options, each with its own unique risks and rewards. Remember, building wealth is a marathon, not a sprint. It takes time, effort, and a solid strategy. The key is to find the right mix of assets that align with your financial goals, risk tolerance, and time horizon. And don't forget, diversification is your best friend. Don't put all your eggs in one basket. If you enjoyed this video, don't forget to give it a thumbs up and subscribe to the channel for more insightful content like this. And hey, let me know in the comments which asset class you're most interested in. I'd love to hear from you. Thanks for watching, and remember, the best investment you can make is in yourself.